Today we're looking at a really detailed analysis report making a contrarian case for Webull Corp.
Right. The core idea is that the stock, Bull, is massively undervalued at around $8.39.
Because Wall Street is pricing it based on old de-SPAC volatility, not its new fundamentals.
And those new fundamentals include a big pivot to, what was it, $21.7 million in net income?
Exactly. So let's jump right in and see how we can strengthen this already highly compelling argument.
You know, the analysis makes a strong case that Wall Street is making this rear-view mirror mistake.
Yeah, that past volatility is overshadowing this huge profitability pivot Q3. The core argument is solid.
It is, but I think it stumbles a bit by leaning too heavily on this generic idea of a SPAC stigma.
Okay.
I mean, sophisticated money managers, they don't just hold on to a vague stigma, not unless it translates into a material, identifiable risk they can see today.
That's a great point. It's too broad. If you're going to claim the market is wrong, you have to really understand and then dismantle its specific argument.
You have to meet them where they are.
So to maximize the impact of the core thesis, the analysis report should explicitly name and neutralize the likely existing bearish arguments, rather than solely relying on that blanket explanation of SPAC stigma.
Yeah, and the weakness is pretty clear. The analysis correctly identifies the historical volatility problem, that huge drop from almost $80. But it doesn't really articulate why smart Wall Street players would still be skeptical today, even after seeing the profitability numbers.
And that creates a potential trust gap, right? A reader might think, well, is there some risk this report just missed?
Exactly. You're asking for trust on a contrarian call, so you have to close every single loophole.
So the suggestion here is pretty straightforward. The report needs a dedicated, probably brief section that isolates the most likely counter-arguments, the real bear case.
And then immediately uses the new financial evidence, especially that profitability pivot, to just dismantle them one by one.
That move right there, that transforms the whole narrative. It goes from Wall Street is dumb to something much more nuanced.
To Wall Street is missing this one specific, very material change. Let's talk about how to do that.
Okay, first thing is, you have to tackle that volatility head on. It's the elephant in the room.
Right, so for instance, instead of letting high volatility just be this, historical stain on the stock, the report could frame it as the opportunity. It's the source of the compression, and you can use that $21.7 million net income figure as proof.
As proof that the volatility risk has been fundamentally contained by cash flow, you've put a concrete profit floor under the stock.
Exactly. You're turning a liability into the very reason for the immediate upside. It's not about historical risk anymore. It's about current, proven stability.
Love that reframing. So what's the other big bear argument? Probably the sustainability of the growth, right?
Of course. Is that 55% year-over-year revenue growth just a one-off?
Yeah. If critics think it's a fluke, we have to show them the engine is now structural.
And the report can do that by explicitly citing the monetization through options, futures, and commodities.
Right. You link the growth directly to those stickier, more advanced products.
And you showed that the growth engine is now tied to a deeper product suite, not just, a temporary boost in user acquisition.
That directly counters the sustainability argument. You're proving a shift to higher quality, more reliable revenue.
Okay, so once we've done that, once we've neutralized the bear case, we can really get into the valuation.
Because right now, the valuation section feels a little too generic, a little too reliant on averages.
Yeah, so while the comparison of Webull's price-to-sales multiple of about 6.2 against historical fintech multiples is useful, the analysis report can significantly strengthen the valuation argument by leveraging the quality of the company's specific monetization strategies.
Being cheap is a good start, but it only gets you halfway there,
Exactly. A PS of 6.2, it sounds like a bargain. But to justify that high-end analyst consensus of 1615,
which is almost a 96% upside.
Right, for that, you need a premium argument, not just an average one.
And the weakness is that the report kind of relies on this hope that the stock will just generically re-rate to the industry average of, say, $12 to $15.
It's too formulaic. It doesn't really earn that high-end target. A target that big needs a much stronger justification.
Okay, so the suggestion is that the report needs to connect those specific revenue streams, the options, futures, and commodities, to higher margin profiles.
Yes, we're effectively arguing that Webull's type of revenue deserves a premium multiple, not just an average one.
And that is such a critical shift in focus. It's no longer just, this is cheap because of a stigma.
It becomes, this is structurally better positioned for margin expansion than its peers. You're showing the inherent leverage in the business model.
So let's dig into that product mix a bit. Why does that matter so much to a valuation analyst?
Well, those products, options, futures, commodities, they signal a few really high-value things. First, you've got more sophisticated, more engaged users.
Who are stickier and trade more, right?
Exactly. And second, these services just have better monetization, better payment for order flow, higher potential for net interest margin. The account balances are often larger too.
So the report needs to specifically show how that product mix leads to, say, a higher margin per user.
Or a more reliable revenue base when you compare it to the basic stock commission revenue that a lot of other fintechs rely on.
It's not just the top line growing, the bottom line is expanding faster because of the product strategy.
And we can use that to be way more precise in our comparisons. So instead of just a broad PS comparison, frame it around profitability metrics. Since Webull just hit that $21.7 million in net income while growing 55%, you have to highlight how rare that combination is.
It's the difference between a growth story that promises future profit and one that's delivering profit right now.
Yes, and that combination justifies a path to exceeding that generic $12 to $15 range. It makes the $16.50 target actually seem achievable based on fundamental quality, not just a hope for re-rating.
That's a powerful 1-2 punch. First, you kill the bear case with profit, and second, you justify the premium with quality revenue. Now let's tie it all together.
Okay.
Because right now, the material lays out the fundamental pivot and then the technical price action, the charts, as two separate sections.
I see that. Yeah, there's a disconnect. It's kind of like you're presenting a motive, and then you're presenting a fingerprint, but you never explicitly say the fingerprint belongs to the person with the motive.
Right. You're forcing the reader to make that final connection, and they really shouldn't have to.
I think fixing this is where the thesis becomes truly powerful.
So the analysis report would achieve a more powerful and integrated investment narrative by explicitly linking the technical price action observed on the chart to the underlying fundamental profitability pivot.
And the weakness is just that separation. You've got financial evidence here and technical analysis over there. It splits the why, the fundamentals, from the what, the price action. It just dilutes the force of the argument.
So the suggestion is to weave them together. Weave the technical observations, like that firm rejection of the 757 low.
And the signs of institutional accumulation below 830.
Weave those directly into the discussion of the Q3 profitability results.
Yes, because that gives you instant validation. It shows that smart money has already started pricing this in.
It turns the technicals from just, interesting patterns on a chart into validation metrics for the core thesis. It's real-time proof of concept.
So when you're discussing the $21.7 million in net income,
you immediately state that this fundamental shift is precisely why the stock saw that V-shaped recovery.
Precisely why it rejected 757. That's essential. You're showing the reader that the floor for the stock is now set by profitability, not just by speculation.
The chart confirms the earnings power. I like that.
And you can take it a step further. Use that technical breakout level of $9. It's not just a target on a chart.
It's the point where market psychology confirms that the profitability story has finally beaten the old SPIC stigma.
And that's what opens the door to fill that gap up to $12.
So the technical indicator becomes this psychological trigger.
Yes, the report should frame it like this. The chart is telling you that the institutions who read that earnings report, they got it. They immediately understood the risk profile had changed. Their buying confirms your thesis.
It doesn't just illustrate it. Okay, that creates the unified, powerful narrative you need to convince anyone who's still skeptical.
So, to sum up, this is a fundamentally strong analysis report. It's centered on really compelling proof that net income figure, the revenue growth, the core thesis is excellent.
Right. Undervalued? Why Wall Street is wrong about Webull Corp. It's a great angle and it's well supported.